Welcome to Term Sheet Teardowns. Today we're going to talk about pro-rata rights, what they are, how they work, and why they're important to you as both a venture investor or as an entrepreneur. All right, let's dive in. So to start this off, I want to tell this story about a friend of mine. He was an angel investor, invested in a bunch of great startups, and early on, he didn't really understand the importance of pro-rata rights. What happened there is he started making investments and he invested in this one company, and that company was just on a tear, and it was like growing super fast. But the downside was it required a lot of cash to keep growing. And so they would come back and require more cash. But because they were growing so quickly, the other thing that happened is there were a lot of investors chasing after them. And so they raised at higher and higher valuations and raised lots of cash, but he didn't have a pro rata right. So what would happen is these VCs would come in and they'd be like, we want to invest as much as possible. And my friend and some of the other angel investors didn't have any pro rata rights. And so they weren't able to put more money in. Anyways, fast forward, the company gets acquired, and it gets acquired for like a huge number. And my friend was thinking like, oh, like when I invested in the early round, I owned, like a pretty sizable portion of the business, like pushing 5% of the business. And so he thought, wow, they just got acquired for like billions of dollars. Like my stake is going to be worth tens of millions, maybe even $100 million. But what he didn't realize was that the company over time had raised so much money in subsequent rounds that he had gotten massively diluted. He thought like, oh, maybe I lost like 1%, 2%, something like that. But in reality, he ended up going from like 5% down to like sub 1%, and had a much lower outcome than he had thought in his mind. Now, granted, he did just fine on the investment, but it wasn't the outcome that it could have been because he didn't have the pro rata rights. And the other thing that was interesting is that had he had those rights, he actually, even if he couldn't have funded them, they would have been valuable to him. And we're going to dive into some of the reasons why. Okay, so first of all, what is a pro rata right? What am I talking about? Well, as you can probably guess from my story, it has something to do with the ability to maintain ownership in the company over time. And at its fundamental, simplest form, a pro rata right is the ability to invest more money in subsequent funding rounds so that your ownership doesn't decline, or doesn't decline by too much. You don't get diluted by future cash coming into the business. So an anti-dilution right basically gives you the ability to avoid dilution from additional capital coming into the business. And the way it works is it basically gives that investor that has the right the ability to invest more money. At its most fundamental level, a pro rata right is simply the right to continue to invest in the company in subsequent rounds. Let's provide a more concrete example of what these pro rata rights look like. Let's assume that you're an investor and you're trying to decide whether or not you should invest with pro rata rights or not. So let's say with pro rata and without pro rata. What do those outcomes look like? Well, okay, so at the seed stage, let's say you as the investor, you're the early stage investor, first one in, you're gonna lead the seed round. You're gonna write the biggest check, and you're like, okay, let's do $1 million at a $10 million post-money valuation. That would mean that you would own 10% of the company. Whether you have pro rata rights or not, in that first round, you still own 10% of the company. And the value of your investment is $1 million, right? That's what you invested. And I'm putting it here because it's going to change over time and we want to keep track of it. So then fast forward, company successful, doing great, awesome. We're now at the Series A stage, okay? And in the Series A, they find a new investor that comes in and they want to invest in the company. And they say, you know what, we're going to invest a total of $10 million at a $40 million post-money valuation. Or in other words, the investors are going to be buying 25% of the company. Now, if you have pro rata rights and you decide you elect to participate and invest, then that means that you're going to need to invest $1 million in order to maintain your 10% ownership in the company. And the way you calculate that's really simple. It's going to be this 10% times this round size of $10 million. That's going to give you this $1 million pro rata that you need to invest in. And the way this math works out is if this is a post-money valuation, then the pre-money valuation here is $30 million. Which means I own $3 million of the company before they raise their Series A, right? Because I own 10%, 10% times 30. And then I'm going to put in $1 million. So now my total investment in the company is that 4 million. And I simply divide that 4 million by 40. And that gives me my 10% ownership. So you can see how this $1 million additional investment allowed me to maintain my 10% ownership in the company. Over here, I'm not going to participate. So I still have to get this $3 million of value in the company, right? But I'm not putting any additional money in. And so in order to find out my ownership percentage now, I simply divide the two. And now my ownership percentage has gone from 10% down to 7.5%. And accordingly, the value of my investment is this $3 million. Now, I'm still feeling pretty good, right? I invested $1 million and it's now worth $3 million. So I'm up 3x. That's pretty great without having to put any more capital in. But you can see my ownership percentage has already declined by 25%, which makes sense because that's how much money was purchased by the company. All right, let's talk about the Series B. So let's say the Series B comes along and the company's been doing well. And so Series B investors want to invest $20 million at a $100 million post-money valuation. That means that the company is selling 20% of the company. Or in other words, if you don't participate, you're going to get diluted by 20%. So what does that mean in terms of participation? Well, your pre-money here is going to be $80 million, right? It's just $100 million minus the $20 million. So pre-money valuation of 80 million. And then what we're going to do again is we're going to say, okay, 10% of 80 million. The value right now before investing anything is going to be $8 million. And if I want to maintain my ownership, then I need to do 10% of the 20 million that's being raised. So that's another $2 million, right? That gives me a total of 10 million divided by 100 million. And I still maintain my 10% ownership stake. Then we go over to here to our calculations if you didn't have a pro-rata right and or didn't participate at your pro-rata. So in that case, you take the 7.5%, you're going to multiply it by this $80 million because that's the pre-money valuation of the company. So 7.5% times that 80 million, that's going to give you a value of 6 million. Or in other words, 6 million divided by 100 million. And that's going to be equal to 6%, right? So now you've gone from 10% to 6%. All right, let's fast forward. We get to our exit, okay? Let's assume the business gets acquired for $500 million. Hey, that's a pretty good outcome, right? So in this case, this example with my pro-rata is really simple. I just take the 500 million, I multiply it by my 10%, I get $50 million that's returned to me in cash. I put in 1 million, right, originally, plus another million, plus another 2 million. So I invested 4 million in total. That gives me a total return of 12.5x. That's pretty good. And a total cash return of $50 million. Now, if we look at our example where they didn't participate at their pro-rata, what that looks like is we just take our 6% and we're going to multiply that 6% times the 500 million. And that's going to give us a return of 30 million. So pretty good still, right? And all I did originally was invest that $1 million. So, 30 million divided by 1 million gives me a 30x return. Now, of course, this 30x return is much better than the 12.5x return, but look at the difference in cash, right? In this case, I got $50 million back, and in this case, I only got $30 million back, which is a delta between the two of $20 million. That's a lot of money, and especially if you've got a relatively small fund, you just missed out on $20 million because you weren't able and or willing in some cases to invest $3 million. I mean, being able to turn $3 million into $20 million is still pretty dang good, and you missed out on that. This further compounds if you think about venture capital in terms of it being what we call power law distributed, where you're only in your whole portfolio, you're only going to have a few deals that generate massive returns. And so you can imagine like, hey, I didn't keep participating and put more money into this one winner that I had right here. And because of that, instead of generating the 50 million potential that I could have returned, I only ended up generating 30 million, right? And so I missed out on this big chunk, and then my next best deal might not make up for it, right? And so on and so forth. So it becomes super important that in the game of venture capital, you identify your winners and you keep putting in as much money into those winners as you possibly can. Because even though your multiple overall will drive down over time as the business becomes more and more highly valued, what you're really looking for is cash that you can return back to your investors. Just some considerations around pro-rata rights. As a venture capitalist, you want pro-rata rights. Just like I said with power law, you want to identify your winners and you want to plow as much money into those winners as possible. That's how you end up generating really great returns as a venture capitalist over time. The other thing is, like I said earlier, by maintaining your ownership in the company, it gives you a little bit more control, whether that's board seats or voting rights or whatever it might be. And the reality is, like, there's a saying in the industry, you want to be at the table, not on the table. And so the more rights you have, like pro-rata rights, gives you the ability to sit at the table with the other players and dictate what happens going forward, as opposed to being on the table and having other people come in and take your rights and your potential investment opportunities away from you. The other thing with pro-rata rights is, as we went through the example, if you participated with your pro-rata, you would have invested a total of $4 million. Now, if you've got a relatively small fund, like let's say your fund is only 50 million in size, 4 million could be a lot, and that could be a really challenging thing for you to keep investing that much money over time in the subsequent rounds. But these rights can still be really powerful and valuable to you as a venture capitalist, because in many cases, they give you one of two things. One, they give you more negotiating leverage when the company goes to raise more money. That could be, hey, I'll give up my pro-rata right, but I want to keep my board seat, for example, right? It gives you that ability to better negotiate. The other thing is that you can effectively sell or give these pro-rata rights to others. So what you've seen in recent years is that venture funds will raise what are called like expansion funds or pro-rata funds or hits funds or whatever it might be to take advantage of these pro-rata rights, where they don't want to have the impact on their multiple go down, but at the same time, they recognize that this is a really great company and they want to keep participating. And so in that case, these funds will actually set up new funds, charge new fees to investors, so on and so forth, to take advantage of the value that exists within the pro-rata rights. The other thing that they could do is they could effectively hand these pro-rata rights over to their LPs. And it can be an effective tool when you go out to fundraise, is basically say, hey, we're going to sprinkle cash around all these different investments. We're going to get pro-rata rights on all of them. We're going to share those with you, our LPs. That's why you want to invest, because you can double and triple down in our best companies. Now, if you're not an entrepreneur, why would you want to have pro-rata rights? Well, you might be looking at it and thinking, pro-rata rights, like I don't want to give more rights away to venture capitalists, right? It just gives them more negotiating leverage against me potentially in the future. One of the biggest reasons why I think it's smart as an entrepreneur to give pro-rata rights is that it basically like tees your investor up to keep putting more money into the company over time, and gives you good visibility in terms of like, okay, this investor has a pro-rata right. As long as we're doing a fairly decent job, they're a little, like that's money that I can kind of expect to come in. And if you're doing really, really well and the new investor comes in and says, hey, we want a bigger chunk than what's available after the pro-rata rights, investors can always waive their pro-rata rights. And so you still have a decent amount of flexibility. Also, most VCs recognize that pro-rata rights are one of the most important rights in the term sheet. And so it's something that they're going to care a lot about when making an investment decision. And I know many investors that will straight up walk if they don't have pro-rata rights, because they understand the name of the game. And that is, like I said earlier, investing in companies, identifying the really great ones, and plowing as much as you can to own as much of you can of those companies over time. Anyways, if you enjoyed this term sheet teardown, check out some of my other term sheet teardowns, like the one where I cover liquidation preferences. Today has been all about the upside. That one's all about the downside. Thanks for joining.